The S&P 500 hit another record high in 2026. The Federal Reserve is preparing to appoint a new chairman. Wall Street is euphoric. Goldman Sachs, Deutsche Bank, they're all shouting targets of 8,000 points. But have you ever stopped to think? Beneath this facade of peace and prosperity, the money you worked so hard to earn is likely to be devoured within the next year by a storm you can't see and haven't imagined. I want to uncover the truth behind this market boom. I see 3 huge cracks, and each one is a ticking time bomb. By the end of this video, you will understand why the market is walking on a very dangerous tightrope, while most people are still dancing on it. Recently, people have asked me, the market is booming, and my stocks are making money. Why have your recent teaching become so cautious? That's a great question. It means you've started to think independently instead of just following the herd. When the fireworks are at their highest and brightest, that is often exactly when they are about to fall. Market risk never appears when you've hit rock bottom. It accumulates quietly when prices rise to the point where everyone loses their mind. You've probably seen the classic movie, The Big Short. The character Mark Baum was based on Steve Eisman, the fund manager who famously foresaw the mortgage crisis. Steve Eisman has been very vocal about the market in 2025 and 2026, and I believe every investor needs to listen closely. He believes we are in an extremely dangerous K-shaped economy. What is a K-shaped economy? Picture the letter K. One arm points sharply upward, head held high. The other leg dives sharply downward. This perfectly illustrates our current situation. A small segment of the economy, specifically AI and tech, has seen explosive growth. Meanwhile, the vast majority of the real economy is like a kite with a cut string, quietly sliding down. This isn't just imagination. US GDP growth in 2025 exceeded 2%. Adding approximately $500 billion to the economy sounds healthy, right? If you look closer, over $400 billion of that growth, a staggering 80% came from a single field, AI-related capital expenditure. Think of it like a classroom where the average score is a solid 80. But if you check the report cards, you find a few geniuses getting 100 in every subject, while most of the class is actually failing. Is that a healthy class? Our economy is that unbalanced classroom? If you remove the single engine of AI, the rest of the US economy shows almost zero growth, or worse, it's shrinking. It's like a giant Boeing 747 flying high on only one engine, while the other 3 are shut down. What happens if that one engine stalls? This division is vivid in the stock market. The S&P 500 rose 17% in 2025, but the gains were highly concentrated in the Magnificent Seven. Many traditional industries, manufacturing, consumption, and the small businesses that serve our daily lives performed poorly. This explains why you might feel confused. The news says the market is hitting new highs, but your own account hasn't made much money, or maybe you're even down. You likely own assets on the downward leg of the K. Prosperity is happening, but it might be someone else's prosperity. This leads to my first warning. Don't be fooled by the index. You must see the cracks. Crack number 1, AI bubble. Now I know many of you will say you're too pessimistic. AI is the 4th industrial revolution. Look at NVIDIA. You're right, AI will change the world. But great technology and good investment are 2 different things. The internet was great technology, but investors who bought indiscriminately in 2000 lost everything. As legendary investor Peter Lynch said, when everyone believes something will only go up, that is when you need to be careful. Right now, companies are spending fortunes on a vague future. Bank of America estimates that Google, Meta, Microsoft, Amazon, and Oracle spent a staggering $399 billion on AI in 2025. Deutsche Bank predicts that by 2030, the spending will hit $4 trillion. To put that in perspective, $4 trillion is equivalent to the entire US Apollo moon landing program, adjusted for inflation, multiplied by 10. The moon landing had a clear goal: defeat the Soviets. Today's spending is what Deutsche Bank calls investment without guaranteed returns. Why no guarantees? Because of 2 fatal bottlenecks. First, electricity. Data centers are power hogs. Goldman Sachs forecasts that data center power demand will grow 175% in the coming years. By 2030, they could consume 12% of all US electricity. But building new power plants and upgrading grids takes years. It's like buying a supercar only to realize the city has run out of gas. Second, monetization. Tech giants are panic buying NVIDIA chips because of FOMO, fear of missing out. They aren't buying because they have a clear way to make money. They're buying because they're terrified of falling behind. But where are the killer apps that businesses will pay for? Chatting and generating images are fun, but are they profitable enough to justify trillions in spending? NVIDIA is currently selling the shovels in this gold rush. But if the gold miners, the tech giants, can't find enough gold to cover their costs, they will stop buying shovels. If that happens, the valuation of the entire AI chain risks collapse. Does this mean you avoid AI? No. It means you use the 3-stage framework. Stage 1. Undervalued and overlooked. High potential, low cost. Stage 2. Verified growth, steady rise. Stage 3. Hype and stories current AI state. We are largely in Stage 3. Prices have detached from reality. This is when retail investors rush in to hold the bag. Smart money looks for the next Nvidia in Stage 1 rather than chasing the bubble that could burst at any moment. If you want to learn systematically how to discover those Stage 1 companies, the ones with the potential to become the next, it's Nvidia rather than the overhyped bubbles. I sincerely invite you to check out our free stock investment masterclass. We've condensed all our practical experience into a set of effective methods that even ordinary investors can master. You can find the link in the description below. Remember, seeking knowledge before investing is always safer than treating your hard-earned money like a gamble. Crack number 2, the private credit iceberg. If the AI bubble is the sword hanging over our heads, this next risk is the iceberg beneath the water. It's called the private credit market. You might not hear about it often, but it is massive. By the end of 2024, assets in this sector reached $3.5 trillion, larger than the GDP of France or Canada. Private credit is lending that happens outside the banking system, run by giants like Blackstone and Apollo. Because they bypass traditional bank regulations, this market is an opaque black box. It reminds me of the subprime mortgage crisis of 2008. Back then, banks packaged bad loans into safe products. Today, private credit lacks transparency. There is no public database. We don't know the true quality of these loans or the borrower's ability to repay. UBS recently warned that private credit defaults could rise by 3% in 2026. In a $3 trillion market, that's nearly $100 billion in losses. If a recession hits and corporate profits fall, this hidden debt bomb could detonate. Crack number 3, valuation reality check. Still think I'm too bearish? Let's look at 2 truth teller indicators. The Shiller P/E ratio. This measures price relative to 10-year average earnings, adjusted for inflation. It smooths out short-term noise. Currently, the S&P 500 Shiller P/E is around 40. In the last 140 years, that number has only been surpassed once, the peak of the dot-com bubble in 2000. We are more expensive now than we were on the eve of the Great Depression in ETSO 929. History tells us that when valuations are this high, returns over the next decade are often zero or negative. The Buffett indicator, this is the total market capitalization of all U.S. stocks divided by U.S. GDP. Warren Buffett calls it the best single measure of valuation. A fair range is 75% to 90%. Right now, it's at an astonishing 222%. We are in uncharted territory. Why isn't Wall Street warning you? Their incentive is to sell you stocks and chase rankings. My incentive is to help you protect your wealth. So what should you do in 2026? I don't recommend trying to time the exact top. That's a fool's game. But you can prepare like a captain before a storm. Audit your portfolio. Be honest. Is the company you own reasonably valued based on actual profit or just an AI story? Does it have cash flow? If the market drops 50% tomorrow, would you panic? If you hesitate, consider taking profits. Stockpile ammunition. Cash is a position. It's not about being bearish. It's about being ready. When the crash comes and quality assets go on sale, cash is the weapon that lets you buy the bottom. Warren Buffett held over $380 billion in cash in short-term bonds in late 2025. He is waiting to catch gold in a bucket. Focus on intrinsic value. Ignore the daily red and green. Focus on the business. Price is like a dog walking with its owner. It runs ahead and lags behind, but it always returns to the owner value. Continuous learning. The rules of the game change. You must invest in your own financial literacy to keep up. Looking ahead in 2026, we face massive political uncertainty. First, Federal Reserve Chairman Jerome Powell's term expires in May. President Trump has emphasized that anyone who disagrees with him cannot lead the Fed if a loyalist is appointed. Monetary policy could become politicized, leading to loose money and reignited inflation. However, the Fed's voting committee also reshuffles in 2026, bringing in 3 new hawks who favor higher rates. We could see a power struggle between a president who wants cuts and a committee that wants caution. This creates chaos and volatility. Second, the 2026 midterm elections. The Democrats currently have a 33% chance of controlling the Senate, but a 74% chance of taking the House. Historically, the ruling party loses seats in midterms 90% of the time. If Republicans lose full control of Congress, tax cuts and deregulation could hit a wall. History shows that midterm years are often the most volatile for the S&P 500. Conclusion: crisis is opportunity. This might sound scary, but I want you to be excited. Crisis implies danger and opportunity. True wealth is built during the crises that others fear. I hope this video serves as a wake-up call to maintain your calm while others are manic. I want to hear from you. Which risk concerns you the most? Have you found any springtime stocks that are undervalued? Let me know in the comments. If this helped you, please like and subscribe. I'll see you in the next video.